So, welcome everybody. Welcome to the second chapter in our course International Economics. Today I would like to talk about data of macroeconomics, and we want to look at the three very important macroeconomic variables: GDP, inflation, and the unemployment rate. The learning goals of chapter 3 are as follows. Like after you have worked through this chapter, you should be able to name and apply different definitions of GDP. You should explain why GDP is not a perfect measure of economic activity. You should know differences between nominal and real variables, as well as level and growth variables. You should know that some problems can arise in case that we measure inflation, and also there might be some problems in case that we measure unemployment rate. Let's start with the first measure, like GDP. And here it is the case that we can come up with 4 different definitions of GDP. The textbook only talks about 2 definitions, but when you really read this second chapter, it is the case that 4 different definitions pop up. So GDP is a measure of the aggregate economic production. If you want to, it can be regarded as the mountain of goods and services produced, like the value of this mountain of goods and services produced. Let's be a little bit more specific. There are 2 definitions according to the so-called production approach. First definition, GDP is a sum of the value of the final goods and services in the economy produced during a given period. Definition number 2, GDP is the sum of the value added on each layer of the economy. Third definition, the income approach. GDP is the sum of incomes which are generated in one economy during a given period. And the fourth definition, composition of GDP, it's the aggregate demand of goods from the different sectors of the economy. When you look at these 4 definitions, it's very hard to find out what are the differences, what are the similarities between the different concepts. So it really makes sense to come up with a numerical example. And that's what we do right now. We have a look at one economy, and in this economy there are only 2 firms. Firm 1 is a steel company and firm 2 is an automotive company. The steel company is producing steel and is selling the steel to the automotive company, and the automotive company is using the steel as an input factor, as an intermediate good, and in the end the automotive company is producing cars and is selling these cars. Let's have a look into the profit and loss statement of these firms. Like the steel company has sales of 100, expenditures in form of wages of 80, so the profit generated in this company is equal to 20. Then the steel is sold to the automotive company as an intermediate. So you can see here the value of 100 euros representing the steel. The automotive company is selling the cars for 210. The wages are equal to 70. The intermediates are equal to 100. This is the steel. And the profit generated in company 2 is equal to 40. Furthermore, we are assuming here that the cars are bought by private consumers, 150, companies as investment goods, 20, government, for example, uses the cars as a police car, and then some foreign countries are importing the cars. This is the setting of the economy, and now we can look at the different definitions. Production approach 1, GDP is the sum of the value of the final goods and services in the economy which are produced during a given period. Only company 2 is producing final goods, So only cars serve as final consumption. So the sales in the automotive industry, this is equal to 210, and therefore the GDP is equal to 210. Let's have a look at the production approach number 2. GDP is the sum of the value added on each layer of the economy. So here it is very important that in the first step we have to find out what is the value added in company 1, what is the value added in company 2. So we have to sum up all the added values. The production value at each stage of the value chain has to be determined. The value added is equal to the value of production minus the value of the intermediates. So in the steel company, it's very easy. The value of production is equal to 100 from the sales. The value of the intermediates is equal to 0. So the value added is equal to 100. This looks different in the automotive industry. There, the sales volume is equal to 210. So the value of production is 210. The value of the intermediates, like steel, is equal to 100. So the value added is only 110. And now we can sum up the value added on each stage of the economy, and then we end up also with a GDP of 210. Let's have a look at the third approach, the income approach, where the definition is GDP is the sum of incomes in the economy which are generated during a given time period. So we have to split the wages generated in the steel industry and the wages generated in the automotive company, and we also have to look at profits. So wages in steel is equal to 80, wages in automotive is equal to 70. So in the whole economy, the wages are equal to 150. 20 units of profits are generated in the steel industry and 40 units of profits are generated in the automotive industry. So the profit is equal to 60. And when we now sum up the income generated in our economy, it's once more the case that the GDP is equal to 210. Some students have problems with this definition because they are always using income as a synonym for wage rate. This is due to the fact that most of the students, when they are generating income, it is frequently due to the fact that the student is providing labor services at the labor market and is just receiving wages. But in case that this student also has like some stocks or some bonds and is able to provide capital at the capital market, then the student would also generate income in form of dividends or interest. And we should not forget about the profit like dividends and interest because it is also a source of income. So income is not a synonym for wages. We also have to look at the profits, dividends, and interest. And then when we sum up, once more, GDP is equal to 210. The last approach was the composition approach. So we have to look at the aggregate demand in the different sectors of the economy. So we have to look at consumption, investment, government spending, and net exports. And when we once more sum up, then it becomes clear that demand of goods is equal to supply of goods. So GDP, according to this concept, is also equal to 210. So all the four different concepts, they come up with the same information that the GDP is equal to 210, but each definition is looking at this value from a different perspective. And it really depends in the one or the other situation, the one or the other definition is more appropriate to use. And we will use this kind of concept within this lecture later on. A second concept which is really important is real versus nominal GDP. So let's also come up with a numerical example to compute nominal GDP and also to compute real GDP. In the textbook, there are always some examples with apples and oranges. So let's stick to this example and say that PA is the price of an apple, A is the number of apples produced, PO is the price of an orange, and O is the number of oranges produced. And in 2017, the price of an apple was equal to 1, 10 apples were produced, and the price of an orange is equal to 2, and the quantity of oranges produced is equal to 20. When we now multiply price times quantity in the apple sector and price times quantity in the orange sector, and when we then sum up, then we get to the information that the nominal GDP is equal to 50. So 1 times 10, this is equal to 10. 2 times 20, that's equal to 40. When we sum up, then we get the information that the nominal GDP in 2017 is equal to 50. Let's check what's going on in 2018. First of all, it is the case that the prices of apples increase by 10%. Also, the quantity produced is up by 10%. This is the case in the apple sector, but also in the orange sector. Also here, prices are up by 10%, and the quantity produced is up by 10%. When we now compute the nominal GDP by multiplying price times quantity and then adding up, we get to the information that the nominal GDP is at the level of 60.5. So nominal GDP increased by about 20% because of the fact that the prices increased and the quantity increased. The increase in nominal GDP is a little bit higher than 20%. These last remaining 0.5%, they stem from a combined quantity and price effect. A higher quantity is sold at a higher price. Therefore, we have here this additional 0.5 units in nominal GDP. In the textbook, you can find one focus box, which is called Helpful Hints for Working with Percentage Changes. And I would like to raise your attention to one rule which is used here. And the rule is that the percentage change of a product, price times quantity, is approximately equal to the percentage change in the prices plus the percentage change in the quantities. This is mentioned in equation number 2. The change in percentage terms of this product, price times quantity, is approximately equal to the change in prices plus the change in quantity. We already looked at a numerical example where the prices increased by 10% and also the quantity increased by 10%. And then it was the case that nominal GDP increased by 20%. Let's extend our numerical example with respect to nominal GDP to the year 2019. From 2018 to 2019, we are now assuming that the number of apples produced and also the number of oranges produced is constant. Nevertheless, it is the case that the prices increase from 2018 to 2019 in both sectors. And hence, it is also the case that here nominal GDP increases due to the fact that the prices increase. Therefore, we can conclude that inflation causes an increase in nominal GDP. But what if one is interested in the mountain of goods and services, whether the mountain of goods and services increased or whether that's not the case? When we look at nominal GDP, then we are misleaded because nominal GDP is increasing despite the fact that the mountains of goods and services is constant between 2018 and 2019. Therefore, we have to calculate so-called real GDP by using two different methods. Like one is the base year method and the other one is the chain weighted method. Let's have a look of how real GDP is computed. First of all, it is the case that we have to choose a base year, and here we opt for 2017 as a base year, and then we keep prices constant. So prices are constant, equal to 1 when it comes to the price of an apple, because the apple price was equal to 1 in 2017. Also, we keep the prices of oranges constant, equal to 2, because 2 was the orange price in the year 2017. And then we just once more multiply through times price times quantity plus price times quantity, and we get here the information about the real GDP. From 2017 to 2018, real GDP increases by 10% because the quantity of apples and the quantity of oranges is up by 10%. But then from 2018 to 2019, real GDP indicates that real GDP is constant because the production of apples and oranges is constant, and hence also the mountain like of goods and services produced, the real GDP is constant. So when we talk about growth, the growth of the economy, then it's important that we have to talk about the change, like the relative change in real GDP. It is not so appropriate to talk about the change of nominal GDP. And here you always have to be careful, like when you read in the newspaper, you have to make sure that the journalists also understood this concept and that it is the case that the journalists are writing about changes in real GDP when it comes to the growth rate of one economy. So we have here one example where we use the base year method. I would also like to give a short example where we use the chain weighted method. The base year method was used until the year 1995. About every 5 years, a new base year was chosen, but this method was abolished in the year 1995, and the international statistical offices switched to the so-called chain-weighted method. The idea is that we use the average of the goods prices in 2017 and 2018 instead of the actual prices of 2018. Here you can see two tables. In the upper table, you can see the nominal GDP, like the actual prices in 2017 to 2019 for apples and oranges. And in the lower part, we compute real GDP according to the chain-weighted method. In 2017, we cannot compute any prices because we would need information about the year 2016. So the prices, according to the so-called chain-weighted method, are not available in our example. And therefore, we cannot compute real GDP in the year 2017. But in 2018, that's possible. We have to compute the average of 1 and 1.1. This is equal to 105. And also the average of 2 and 2.2, which is equal to 2.1. So we are taking the average of 2017 and 2018 prices, and we are using this average as the price in 2018. And then we just have to multiply through and add up in the end, and then we get a measure for the real GDP. Also here, in the year 2019, we have to compute the average between the price in 2018 and 2019. The average between these two numbers here is 1.21. And when we have done that for apples and oranges, then we can also determine the real GDP. Let's have a look into the real world, like how does the GDP look like in the US in the year 2016. You have here the different components of GDP, and it seems to be the case that here we are using the approach number 4. The approach number 4 is the composition approach, where we look at the different components, the different demand components of GDP. So we are distinguishing private consumption, investment of the companies, government spending, and net exports. The figures like in this second row are in billions US dollar. I think it makes more sense to look at this row with the percentage terms, and there we can see that GDP is used to about 70% for private consumption. What is also important is here this negative sign. The US has a current account deficit, which implies that the US is importing more than they are exporting. This is a very important observation. The US has a current account deficit. It's very important insofar as Trump is always in this trade conflict with China. Like the US has a current account deficit, China has a current account surplus, and therefore, like these economies and also the political leaders are arguing about the current account surplus and the current account deficit. So here we see one source why there is a trade conflict between the US and China. The US has a current account deficit. So this is already the end of the first part of this lecture. In the next part of the lecture, I would like to talk about inflation and the unemployment rate. Thank you very much for watching this first video. Have a nice day. Bye-bye.